Europe believed it was executing a decisive financial strike when it authorized the seizure of $105 billion in Russian sovereign assets to fund Ukraine. But what actually followed was one of the most damaging strategic miscalculations in modern economic history, not because the moral intent was flawed, but because European policymakers fundamentally misunderstood the balance of vulnerability and misjudged who stood to lose more from weaponizing the global financial system. The assumption in Brussels was that Russia depended on European financial access, European markets, and European goodwill to such a degree that confiscating its reserves would impose unbearable costs without meaningful retaliation. Yet this assumption collapsed almost immediately. What Europe treated as a clever solution to a politically exhausting funding problem instead handed Moscow a detailed blueprint for dismantling European economic credibility, and Russia did not merely follow that blueprint, it optimized it. By early 2024, the war in Ukraine had entered its third year. Public support across Europe was eroding, and governments faced rising resistance to tax increases or new borrowing. So when legal teams proposed transforming frozen Russian assets into direct funding for Ukraine, the idea appeared irresistible. Freezing assets during conflict had precedent, but outright confiscation of sovereign reserves by a major economic bloc did not. And although lawyers crafted a justification, the move crossed a line that global capital markets had long assumed would remain inviolate. When the announcement came in March, the political reaction was celebratory. The media praised the creativity, and leaders declared that Russia would now pay for its own war. Yet this triumph lasted barely 2 weeks. Moscow responded not with outrage or threats, but with precision. The first move was blunt and devastating. Russia permanently nationalized all European corporate assets on its territory, seizing factories, infrastructure, equipment, intellectual property, contracts, and entire subsidiaries, with no compensation and no path to appeal. The total value exceeded $120 billion, immediately surpassing what Europe had confiscated. But the deeper damage lay in what those numbers represented. European companies had spent decades building their presence in Russia, developing supply chains, training workers, understanding local markets, and embedding themselves into the industrial fabric of entire regions. Volkswagen alone had invested since the 1990s, employing tens of thousands directly and supporting countless more through suppliers, and in some cities its plants were the economic backbone. All of that vanished overnight as ownership transferred to the Russian state. Siemens lost power infrastructure, rail systems, service agreements, and decades of market positioning. Shell lost stakes in major energy projects that had taken generations to develop, eliminating not only current profits, but future production that underpinned long-term strategy. Hundreds of smaller European firms suffered the same fate, from food producers to retailers, discovering that 3 decades of patient investment now belonged to someone else. Yet Russia did not leave these assets idle. Instead, it sold them at steep discounts to Chinese firms, transferring market share, production capacity, and local expertise accumulated by Europeans over 30 years directly into the hands of their most formidable global competitors. Chinese automakers stepped into Volkswagen's factories, Chinese energy firms assumed control of projects Shell had built, and Chinese industrial companies inherited contracts Siemens once dominated. Europe lost decades of effort in weeks, while China gained them in months. Russia's second move was quieter, but even more consequential. Moscow announced that all exports of energy and commodities would henceforth be settled only in rubles or yuan, eliminating the euro from transactions. European policymakers assumed this would isolate Russia, believing major buyers would refuse non-Western currencies. Yet instead, India, China, Turkey, and others adapted rapidly, establishing bilateral payment mechanisms and expanding existing arrangements. Within months, most Russian trade bypassed the euro entirely, eroding the effectiveness of sanctions that depended on European financial leverage and sending a far more dangerous signal to the world. Participation in Western currency systems was no longer essential. That realization undermined decades of accumulated trust in the euro as a neutral, stable reserve asset. The third move struck at the heart of global finance. Russia, alongside its BRICS partners, announced a $150 billion reserve fund designed explicitly to protect member assets from Western seizure, held outside Western jurisdictions, and denominated outside Western currencies. The lesson Russia had unintentionally taught the world was terrifyingly clear. Sovereign reserves were only secure until Western governments decided otherwise. For countries holding hundreds of billions in reserves, this revelation forced immediate reassessment. Saudi Arabia quietly explored participation, not out of hostility, but out of self-preservation. Singapore began diversifying. Even Switzerland faced reputational damage as its historic neutrality came into question. Capital did not flee dramatically. It drifted. Reserve managers reduced euro allocations incrementally, a few percentage points at a time. Yet in absolute terms, this meant hundreds of billions moving away from euro-denominated assets. The consequences rippled outward as borrowing costs rose, bond spreads widened, and the euro weakened despite intervention. Europe's $105 billion seizure funded Ukraine for roughly a year, but the costs were vastly greater. European companies lost more than $120 billion in assets and entire markets. China gained discounted access to Russian industry. Dozens of countries accelerated efforts to escape Western financial dependence, and the euro's credibility as a reserve currency suffered lasting damage. The core error was strategic, not moral. Europe assumed Russia needed European finance more than Europe needed global trust in its currency, and that assumption proved catastrophically wrong. Russia had alternatives, commodity leverage, and powerful partners, while Europe had sunk corporate investments and a financial system whose value depended on credibility. The policymakers involved were not ignorant. They understood finance, but domestic political pressure to appear decisive overrode long-term logic. And once financial systems are weaponized, no assurance of exceptionalism is believed. The damage extended beyond balance sheets to people. Tens of thousands of workers lost jobs or saw ownership transferred. Shareholders absorbed massive write-offs, and European firms lost competitive positions that cannot be quickly rebuilt. Energy assets that took decades to develop did not disappear. They simply changed hands. None of this was unpredictable. Asset seizure invites retaliation, yet European leaders seemed surprised when it arrived, revealing a complacency born of confronting weaker opponents for too long. The broader realignment continues as alternative payment systems expand. Western infrastructure loses exclusivity, and trust erodes incrementally, rather than collapsing all at once. This episode will not be remembered as the moment Europe punished Russia, but as the moment Europe weakened its own financial foundations. The lesson for the world is unmistakable. Dependence on Western systems carries political risk, and prudent nations will diversify accordingly. That is how economic dominance fades, not through sudden collapse, but through the slow abandonment of trust. What makes the fallout from this decision even more dangerous is that the consequences are not confined to balance sheets or quarterly earnings, but are now bleeding directly into Europe's long-term strategic autonomy. Because once financial credibility erodes, every other lever of power weakens with it. Europe's ability to influence global outcomes has always rested less on military force and more on economic gravity, on being the world's largest trading bloc, a stable financial hub, and a jurisdiction where capital was protected regardless of politics. That reputation took decades to build and only moments to fracture. After the asset seizure, global investors did not panic. They recalibrated, and that distinction matters because panic can reverse. Recalibration rarely does. Central banks, sovereign wealth funds, and multinational corporations began reassessing risk models that had not changed meaningfully since the end of the Cold War. The question was no longer whether Europe was stable, but whether it was predictable, and predictability is the cornerstone of capital allocation. When assets can be confiscated based on political alignment rather than legal process alone, every foreign investor must price that uncertainty into future decisions. This does not mean Europe becomes uninvestable, but it does mean Europe becomes less attractive at the margin, and in a world where capital is mobile, marginal shifts compound into structural change. The impact on European industry is already visible in delayed investments, canceled expansion plans, and a growing preference for jurisdictions perceived as politically neutral or at least non-interventionist. Manufacturing, which was already under pressure from high energy costs and regulatory burdens, now faces an additional headwind as firms question whether long-term overseas investments can ever be truly secure if geopolitical winds shift. This hesitation feeds directly into Europe's competitiveness problem Because industrial leadership depends on scale, global reach, and long investment horizons, all of which are undermined when political risk becomes unquantifiable. Meanwhile, the financial sector faces its own reckoning. Banks, clearinghouses, and custodial institutions built their businesses on the assumption that sovereign assets were sacrosanct, and that assumption underpinned trillions in cross-border flows. Once that norm was broken, even for reasons many consider justified, the precedent could not be contained. Legal scholars may argue that Russia was a special case, but markets do not operate on moral exemptions. They operate on probabilities. If seizure happened once, it can happen again, and that possibility forces diversification away from any single system that claims universal trust. This is why alternative financial infrastructure is expanding so rapidly. Payment systems outside Western control are no longer theoretical hedges. They are operational necessities for countries that cannot afford to gamble their reserves on political goodwill. Each new connection, each bilateral settlement agreement, each non-Euro trade invoice reduces Europe's leverage incrementally, not dramatically, but relentlessly. At the same time, Europe's internal political dynamics are becoming more strained as the economic consequences surface unevenly. Countries with large industrial bases feel the pain first, as lost export markets and higher financing costs translate into job losses and fiscal pressure. Governments face the impossible task of explaining to voters why living costs are rising, while strategic influence is shrinking, all without admitting that a celebrated policy decision helped accelerate the decline. This creates a feedback loop where political leaders double down rhetorically to avoid acknowledging error, further eroding trust externally while hardening divisions internally. The irony is that the policy was justified as a defense of international norms, yet it weakened one of the most important norms of all, the neutrality of the global financial system. That neutrality was not a moral stance, but a functional one, and it benefited Europe enormously by anchoring global capital flows. Once neutrality is compromised, the system fragments, and fragmentation always favors those with scale, resources, and alternative networks. In this environment, Europe is forced into a reactive posture, adjusting to shifts rather than shaping them, while others define the architecture of the future. The longer-term danger is that this episode becomes a reference point in every future crisis, cited as evidence that Western assurances cannot be fully trusted. That perception, once embedded, is almost impossible to reverse, because credibility in finance is asymmetrical, built slowly and destroyed quickly. Even if Europe never repeats such an action, the knowledge that it can is enough to change behavior permanently. This is why the true cost of the asset seizure cannot be calculated in dollars alone. It lies in lost influence, reduced optionality, and the gradual normalization of a world where Europe is one financial center among many rather than the default anchor. None of this means Europe is doomed, but it does mean the margin for error has narrowed dramatically. Strategic decisions now carry higher stakes because the cushion of unquestioned trust is thinner than it once was. History rarely records decline as a single event. It records it as a series of rational decisions that made sense politically in the moment, but proved corrosive in aggregate. This was one such decision. Europe did not collapse. It compromised itself, and the consequences will unfold slowly, quietly, and relentlessly, long after the headlines have faded. I prefer this response.